Okay, so welcome back. I'm glad to be back here with you guys. So let's proceed with what this video is all about. So in this video, I'm just gonna teach you guys about the idea of mitigation and imbalances. Mitigation and imbalances. Okay, so firstly, I did explain this in the previous videos, but if you didn't catch me right, or if you have not checked it yet, so what exactly is an imbalance, right? So what is it? The term imbalance. Imbalance is a gap left between wicks that others may call it price gaps, which in future needs to be filled. What exactly do we mean? We mean that if there's a downtrend, right, it means that okay, let's say let's say we have this is a candle, right? So we have this candle, we have this candle, and we have this candle, this candle here, and we have this candle here, right? So what an imbalance means is that this gap left between this wick right here and this wick right here, right? So this gap here is what we call an imbalance. It means that there was not sufficient amount of orders or volume, so price, if price leaves, it will then come back to fill this and then now proceed with the overall true trend or direction. So let's get into the charts and let's see examples from the from the charts. So as we can see right here, so we have this right here, that wick there, and this wick here, right? So this right here in between is an imbalance, which price comes, as you can see, this wick comes and fills it, and then it leaves, although it doesn't leave permanently, but then price continues with the true trend. So the idea now, this is an imbalance. Now the idea of mitigation comes with this action of price coming to fill this imbalance and then leaving. This is mitigation. Mitigation is simply the fulfillment of imbalances, making sure that there are no price gaps left. So on this chart right here, I'm having a GJ anticipation, where we had this beautiful rally of price up, and then this failure to break structure, right, leaving behind this what, high low, right? No, it's like a lower, I don't know, lower high, yeah, lower high. Okay, so once this lower high was created, price then broke structure right here, based on how we trade, right? So price broke structure here, but also it broke structure here, meaning that there's clearly displacement of price to the downside. So what I expect now is this is where the idea of mitigation imbalances comes to place. So you have your SND to trade from, right? So this was my SND to trade from, where it came from this. So yeah, price came to mitigate an SND here. I don't know, it was in the 4 hour, I'm not sure. So when price came here and then made this absorption move up, and then this push down. So let's clear this, right? So based on the chart, on the time frame that we're on, it means that we have this SND to trade from, right? Because there's nothing left unmitigated here, right? Everything is pretty much filled. As you can see, this move came to fill this imbalance here. So the left imbalance it means that it's just here, right? And we say the most correct supply zone is that which resides with an imbalance either below or above it, basing whether it's a demand zone or supply zone in that instance. So that being said, it means that I had this supply zone, right? And there's tons of imbalances left. So this was the actual move where after the creation of this supply zone, price rallied down, right? It's left this imbalance right here. So this was the actual imbalance. So this is the 50% of it, yeah, right? So from this week to this week is the imbalance, right? So we can see a price came, filled quarter portion of it, it left, it came, it filled half of it. Now notice something to take note on: it does not always happen. I mean, there's nothing in this industry that always happens, right? Everything is a probability, right? So that's why we trade high probability setups, right? Because everything is a probability. There is no strategy, there's no indicator in the world that will give you 100% thing that is constantly there in the charts. Nope, there's nothing like that. Everything is a prediction, is a probability. The only thing you can control in this industry, in these charts, is your risk, right? That's the risk you take is the only thing you can control. You can't control price to come down or to go up, right? So price just goes in its direction based on how the market makers push it. So what we retail traders can do is just control and minimize our risk. So that being said, based on your risk appetite, you can either choose to trade from the most the original supply zone, like this. I mean, S&D zone, it can be whether a supply zone or a demand zone down here, or you can choose to trade from the 50% mitigation of that imbalanced left below or above that supply or demand zone. So for example, right here, right, if you're a person that has a larger, higher risk appetite, you could have easily taken an entry here, right? Because you have your imbalance from here to here, right? And this is the 50% of it, the middle, right? So if price based on your risk appetite, that okay, you just put yourself on a set of rules, right? This works, not all the time, but a lot of time it works, right? So price sometimes may just come fill 50% and leave, or come fill all of it and leave, right? Or break through. Either of that can happen. The only thing you can control is the risk through what? Confirmation, right? So if price comes here and then breaks down, you go to like maybe like a 3-minute chart. Okay, let's go to the hourly so we can mark this portion right here or right here, right? So if you're a person that trades from the 50% mitigation, you can use the rule of 30 to control this, I mean confirm this, so as to minimize your risk, right? Okay, so based on the rule of 30, we have now scrolled down to the 3-minute chart from the hourly. Oh shit.